Welcome everyone. Let's officially get started with today's webcast titled 3 Core Strategies Every Retiree Must Use. I'd like to officially welcome you here today, and I'm very happy that you were able to take the time. I really feel that this webinar is of the utmost importance for you, whether you are currently retired, soon to be retired, or simply in the planning stages for your retirement. So we're going to get everyone going, everyone on the right page as they plan for their retirement years. And so my promise to you today is that in this webinar, you're going to see how we can show you how you can retire with a peace of mind, knowing that you can steadily grow your portfolio, that you can generate income and preserve your capital, the key core elements that we need to be able to continue to keep our money and make more money in retirement. It's such an important topic, and it's unfortunate that so many people just simply aren't ready for retirement. And that's what we're going to address here today. You can go into Google, for instance. You can Google retirement planning, retirement calculators that allow you to calculate how much money you need. There's all kinds of things you can go look for. There's about 1.7 million results just for retirement planning. So, they're out there, and there's a lot of things. Every time you turn around, there's a TV commercial or somebody on there talking about retirement and all the different ways. What we want to do is take all of that info that can be overwhelming and break it down, break through all that noise. And so my goal today is to cut through all that and show you the 3 main things that you should be doing. Okay, first, a little bit about me. My name's Jim Penna. I've been in the securities industry. I took my Series 7 way back in 1992. Before that, I was actually a police officer up in Connecticut for nearly a decade, and decided to leave, got in the securities industry, and worked at some smaller trading desks and then as a market maker for a large trading firm up in New York. So I like to tell folks I went from being a police officer to a market maker. So I went from one side of the law to the other. I like to joke. That is just a joke. So that's kind of my background. So I worked on the trading desk for a long time, moved my family down from Connecticut because I got tired of shoveling snow, and ended up here in North Carolina in the Charlotte area, and found VectorVest and been here for the last 11 years. So it's been a great time, and again, I'm glad you guys took the time to spend some time with us today. So what I'm going to do is what I try to do with all of our subscribers is get them focused on what's important in their retirement accounts, using the VectorVest program to make it easier and to make sure that those retirement goals are laid out properly, and we do everything we can to meet those goals. So we've got a lot to discuss today, so take good notes. I will have a Q&A at the end as well. And also, since we only have an hour today, at the end, if you do want more help, I will tell you where you can go to get more help at the end. And just before we kick off, does that sound good to everybody? Everybody ready to go? You got your pen, paper, door shut, cell phone off? I'm going to try to interact with you guys throughout the day, so you got to type in there and let me know that we're all ready to go. Tamura says yes. All right, there we go. Let's go. I know some folks are saying, hurry up, let's go already. All right, let me start by doing this. I want to ask a quick question. What's the hardest part about preparing for retirement or being retired? What are some of the obstacles or roadblocks that you're running into? You can go ahead and type in some quick answers in there, again, just to get a sense of what we're doing. And Mark says a pretty good one. He just says money. Yeah, that's the hardest part about retiring. And as you guys type in, knowing how much you'll need, fear of a crash, a flaky government, how much do I need, knowing what to spend. Yeah, these are all extremely important things. And so from the sounds of it, how many years ahead of me? My wife? Yeah, Ralph has a good point there. How many years do I have? Earl has really what we're here for. Running out of money in retirement. I've had this conversation with Dr. DeLito as we've talked about what our subscribers are looking for in retirement, and what the worries are, what the questions are. And it all comes back in some form or fashion to, how do I keep from running out of money in retirement? And Dr. D has given me the most pragmatic, most logical answer that I can think of. And he said to me, just tell them to keep making more money. right? And so that's kind of what we're looking at here. It sounds simple enough, and in a sense it is, as long as you stick to a plan and have your focus on the end line there. So I think you guys are in the right spot based on those answers. Now, when we set up our retirement plan, there is some pre-work that has to be done, right? We've got to set goals and visions and ideas of what we're going to do. So I'm going to run through a little matrix here. And I want you to have, as we said earlier, retirement that gives you peace of mind, right? That's our ultimate goal. Whatever that retirement is for you, that you're able to have the retirement that you desire. And what we say is where work is optionable and retirement is affordable, right? To me, that's the definition of peace of mind. So it gives you enough money to do the things you want, the time to do them, and the confidence that you can handle any situation that the market might throw at you ultimately. So to do that, there are three parts of your investing we need to focus on. And number one is going to be the profit side, or what we also call the capital appreciation side, right? The way we profit or grow our capital, in other words, is where we primarily focus on strategies to make money when the market's going up. And you can do it when it's going down as well. We're going to focus mostly on the upside and buying good quality, safe stocks, and as we'll talk about as we go through the next hour. Secondly, we need to focus on what we call provide. We had it with a provide tag there, and that means provide income or generate income. Since we're already building the nest egg with our profit portion or our growth portion, right? We need a way to get some spending cash, a steady flow of cash, so that we're not always dipping into that growth portion of our portfolio. If we want to take some money out to pay some bills or go on vacation or do whatever it is we want to do. And then finally, the last piece, and in my opinion, perhaps the most important, is preserve. And the way we preserve is we want to make sure that any loss we take is minimized the best we can. Right? And there's no trading plan that's going to have all of these things move straight up all the time. We know there's volatility at times in the market. We want to take advantage of the growth periods, and we want to be prepared to preserve in the times when things get a little choppy or turn against us. Right? So that's the key. To do this, we think there are basically 9 overall techniques that our most successful retirees use in their accounts. I'm going to lay those out here quickly, but then I'm going to show you the 3 keys that we're going to focus on. So when we start with capital appreciation and profit, we start by using stocks and some ETFs, mostly high quality stocks here. Those who use all of the techniques take advantage of the leverage of calls and puts and able to profit that way. And then for those who are even more advanced, can go into different types of option trades to help even more. So for profit, that's the top 3 of our first 9. Next, when it comes to the provide side, right, with that income we talked about, we want to make sure we have a plan to capitalize on dividends. That's usually the simplest way to do it. We're going to focus on covered calls. Another, I still think the very best way to continue to make money in your retirement years, so not to run out. And so we'll talk about generating income using covered calls. And again, the most successful, understand things like credit spreads, another way of creating income in your portfolio. And then finally, there's the preserve side. And when we talk about preserving capital and protecting our assets, what we talk about is, the ability to hedge or protect, buy insurance on our portfolio. So hedging is done by using puts or the collar trade. And then again, for the more advanced, the more successful, we'll go into different trade repairs. Okay, so these are all things that we can do to minimize our losses. These are the 9 areas. Now, there's a lot of stuff there, but what I want to focus on more importantly, and again, as I said, we're going to cut through a lot of things, and I want to focus on the 3 core things that you must have. And number 1 is we need to have that profit plan using stocks and or ETFs to grow our portfolio. right? Good, high quality stocks that are rising in price over time so that we can grow our portfolio. Secondly, we want to focus again on providing that steady income. And how do we do that? Well, here it's very easy again to look at dividends. And then if you're not using covered calls, I'll talk about them in a few minutes. You should be, and we'll focus on that. And so we're growing our portfolio. We're generating a steady income so we don't have to continue to dip into that portfolio. And then lastly, we're going to talk about some insurance policies, ways to protect and preserve your retirement nest egg. And that's where we're going to focus on to do that because that's where the proactive part, that's where the management portion comes in, right? We talk about building and managing a portfolio. It's really a two-step process, right? Once we build that portfolio, it's up to us to make sure we manage and protect those assets. So that's what we're going to do today. Our plan is to walk through those. And so that's kind of the intro. And from here, we're gonna get right after it and talk about these techniques and how you can use them and employ them in your own retirement account. The first things we're going to focus on are using stocks. And again, there are ETFs that can help out in both hedging and overall market trends, but we're going to focus primarily on good quality stocks, how to find them and how to build your portfolio using them. And we're going to focus on making money generally when the market is going up and do so in a way that we profit nicely in up markets and again, minimize our risk to the downside. And so to do that, we need to have, and this is most important, we need to play it safe, right? So we're looking at safety first here, and that's what we're going to invest in. That's kind of our mantra, invest in safety first. So in other words, for our retirement account, we're going to want you to look primarily at the safety of the stock. And I'm going to talk a lot about that in a minute. More than anything else is the quality of the company itself. While it's fun to go out and hit the home run, take a chance on, some unknown stock or lower price stock, it's great to hit home runs every once in a while, and we all like to do it. But who can tell me what happens to the home run hitter when he doesn't hit a home run? What happens to a home run hitter when he doesn't hit a home run? Right? He's out, right? There you go. Yeah, he strikes out, right? And so we want to avoid that. So while it is enticing to some people, that's not the way we're going to go. And Russell said, yeah, strikes out. That's exactly what happens. So we definitely don't want that to happen. And what happens when you start to do that, you start to betray what your inner investment style really is. Right? Everybody has their own investment style. Dr. D has written about this in his little green book, Stock Strategies and Common Sense. Everybody has their own unique investment style. And if you start trying to hit home runs or to do things that's not within your comfort zone, we say you invest like someone you're not here, right? You start wearing a mask and it doesn't work. So that's one of the pitfalls that we run across. Another issue that retirees run into and frustrations is when things aren't going their way, when they don't have that plan in place, is that they begin to want to get back any losses or overreact and try to go faster. And we use the analogy that, I know I've got my two sons, when I taught them to drive, right? When you were teaching them, if they were struggling or weren't feeling comfortable, you never told them slam on the gas pedal and go faster, that'll fix it. Right? And it's the same in investing. We want to slow down, right? We want to slow down, reevaluate our plan and our process and focus on the task at hand. And so we say it all starts with, again, a quote from Dr. DeLito when he talks about starting your portfolios. It's good portfolio management begins with buying the right stocks. And I'll probably use several baseball analogies as the day goes on. So I always liken it to a roster, right, or my team. And arguably, the greatest sports team of all time, and I say arguably because I'm sure you could type in others that you might think are, but the 1927 New York Yankees, that's a pretty good roster. And if I were to translate that into my portfolio, I would want those type of stocks in my retirement portfolio, right? So it begins with buying good, high-quality stocks. That's where it all starts. So what I want to do to that point is take a look at a quick little exercise here. It's just which looks better. And if you guys could, in the chat box, as I walk through some of these examples, I'm just going to ask you to type in A or B. Right? This is part of the preparation before we go on the field. This is our spring training, if you will. So just like it is at an eye doctor when you go, I'm going to scroll through some stocks, and I want you to be able to tell me which one is better, A or B. And again, we do this to get into practice for picking stocks for our portfolio. So join me in this little exercise here. So we start with a stock called RARE is the symbol, right? Stock that hasn't been trading very long, a choppy price pattern. Down below on the graphs I'm going to show are the earnings per share and the process and the progress of earnings per share. So I'll ask you, which graph looks better based on that, A or B? Cognizant Technologies, right? B must be better, someone typed in. Okay. Hello. We got a hot mic back there, John. Okay, so Cognizant Technology is the better one. Here we have MAC. Which looks better to you, A or B? B is for better, Bruce says. Right. Then you got Google. Right? So I'm just going to flip through these, and you guys get the picture here, right? Yeah, B is going to be better. We don't want those violent drawdowns, those choppy markets there. Accenture, ACN, is a stock that we want, right? I think we got a live mic in the back, guys. Then we've got EPR, Entertainment Properties, or AOS. Which is the better here, right? That's the kind of stock, my very favorite stock in our entire database right here, AOS. Another stock that hasn't traded very long versus Centene Corp, right? So you get the picture of what we're trying to do. This is the type of stock that we want to fill our retirement portfolio with, okay? This is the type of stock we want to do that with. And I'm having a quick issue. I'm going to pause for 1 second. Stand by. Okay, sorry about that. So these are the type of stocks. This is the picture of the graph. That's why we walk through it. Earnings per share. It's not a coincidence that as earnings rise, so too does the price of the underlying stock, right? So that's what we want to look at. So again, what those stocks have in common were that each of them had that rising earnings per share. Right. And when we talk about in the VectorVest program stock safety, we have a checklist and what we call relative safety on the stock. We'll talk about that in a moment. But these are the things that go into it. So when I tell you we're looking for a high RS or a high relative safety stock, there's a lot that goes into that. We talk about earnings consistency. Does the company make money quarter over quarter, year over year? Does it have consistent financial performance? We look at company size. And the reason we do is to make sure that you understand that just because a company is large, it doesn't mean technically that it's going to be a safe company. And we talk about some different companies like Facebook or United Healthcare or Google, right? These are huge, large companies that are very safe companies. And we contrast it to a company like currently GE. Right, still a large company, but certainly not the safest company on the map right now. So that's what we mean by company size. There's price behavior, right? And we just saw it in the graphs. Are those price movements and earnings per share movements that steady rising pattern? Business longevity is a big part of it on our checklist. How long has the company been around? That doesn't mean a company that's been around for a shorter time is not going to do well or can't do well. But what we're talking about on the very safest stocks have that longer history. And with that history, they show for stocks that do pay a dividend, they have a positive and powerful dividend history behind it. That evidence that they continue grow, not only pay, but grow their dividend year over year. And then finally, just the basic fundamentals, right? That debt to equity ratio. Are they overextended? Are they going to be able to make it through an economy that hits some headwinds at some point? You know, are they set for that as they move forward? So this is the checklist that we use. A lot of folks tend to get buried in a lot of the data when you try to look that up on your own, and it can get very frustrating. And a quick story, I was conducting a seminar, this is a few years back. I want to say we were in Denver. And when we were in Denver, during the seminar at the very beginning, there was a gentleman in the crowd who looked a little tired. He looked like he hadn't slept in a while, and he told me during one of the breaks in a very edgy manner that he had been up leading up to the seminar, and he had done all of this research, looking through things, printing things off, you know, opening books and doing all kinds of things to try to find out what the best fundamentally sound stocks he could, because he wanted safe stocks. And so as we talked about it during the break, I walked him over to our computer. Now, this was a guy, this could have been this guy, yelling for help, buried by all the data. And what he was looking for was relative safety. And real quick, I want to come over to this search. So the Ruler Stocks is a search that we have that finds high RS or relative safety stocks. Okay. And I sat him down, and I wasn't sure, but I brought this search up because I know that the very highest, safest stocks by design come to the top of this list. And so when I ran the list, he had a list of 8 stocks on this crumpled piece of paper. 6 of the 8 stocks were in this list of the top 10. And the other 2, I think, were like 11 and 12 or 12 and 13, something like that. And so I wish I could have had it on film to use to show you how, as we said, getting buried in that data can certainly affect you as you try to find these stocks. And so I skipped around a little, but here on our relative safety slide, we talk about the scale. In the VectorVest program, we have several proprietary parameters or indicators that are put onto a 0 to 2 scale that Dr. DeLito created. And as you see, and this is the same for all of our parameters, on a 0 to 2 scale, anything from 0 to 0.89 is poor, 9 to 1.09 is fair, and then anything above 1.1 all the way up to 2.0 ranges from good to excellent. Right? And so what we're going to focus on is somewhere in this very good to excellent range when we're looking at relative safety stocks. Okay, and that's that indicator is the indicator we use when we look at this checklist. Debt to equity, dividend history, longevity, behavior, company size, all of those things are focused on that checklist. So as an example, this is, again, one of the searches of many that we have to use there. So we have the ability to go in there and find these stocks pretty easily. Okay, so we have the ability to do that. Now, again, if you're on this webinar and you're new to VectorVest, just know that our system generates signals on the market. And if you are with us, you understand our confirmed up call. We have our different market timing indicators. So our most conservative call is the confirm call. And so when that confirmed up call comes, that tells us it's okay to go buy these high safety stocks. And again, this is the type of stock that we're then going to begin to build our portfolio with. Strong earnings. And I think someone had typed in, why is AOS my favorite stock? And this picture is pretty much it. Pays a dividend. I'm able to sell covered calls against it. It's just, you know, it's a good quality company that does well. Now, when we continuously at the right time, when the market trends say it's time to get in there, when we focus on filling a portfolio with those high RS stocks, these are the kind of results that we've come to expect. Now, some perform better than others. It depends what type of strategy you're in, but we have trading plans, and we'll talk about this one later on. We have a growth portfolio that focuses on high safety stocks. That in this case, we have one that's up, averaging over 50% annualized rate of return, and that's just as of 2 days ago close. Right, so that's what happens. That's the result of using these high RS stocks. And so what we want you to do is to be able to avoid the roller coaster, right? When you're not, and what we mean by roller coaster is slow on the way up, right? You have a slow, steady climb when things are going up, but when things turn against you, it's very quick to the downside. And that's what we want to avoid. And so I'll ask you guys, which would you rather have, the roller coaster ride or that nice, steady climb that we see there? Type in there real quick. I'm going to take a quick sip of water, and you guys let me know. I think I know the answer. Yes, Peter says the steady climb. Yeah, Steve says RS. Yep, steady climb. Yeah, it's obvious there. I just needed an excuse to go get a drink of water. This is what we're looking for in some form or fashion. We're looking to grow that portfolio. So that focuses on the growth part, our capital appreciation, finding good quality stocks in a rising market. It's as simple as that. And we make it simple by helping you find those high RS stocks, those safe stocks. Next, we're going to get to that second core principle, which is we call provide. We use the 3 Ps, right? Profit, provide, and preserve. And here, when we talk about provide, we're talking about income generation. We're looking to generate income. And here we're going to use dividends and covered calls. So we'll start with dividends, right? And we want to get paid, right? You want to get paid while you're working towards or in your retirement. That's the key there, on top of growing your portfolio. One of the benefits in focusing on these really safe stocks is they typically pay a nice dividend, some better than others, and you want to be able to capitalize on that. And everybody knows about dividends, right? You know, it's what a company's share of their earnings that they pay to their shareholders. Now, oftentimes what people will do is go out and just say, well, there's a super high yielding dividend stock. I'm going to go ahead and buy that one. And they'll sacrifice the quality of that underlying stock just because they see high yields coming. Right? And that's the exact opposite of what we want you to do. I don't ever want you chasing a high yield just because it looks like you're getting a great payout if the quality of the underlying stock doesn't warrant that. Okay, so it's not always easy to find those best stocks, but we do our best to make it easier for you. Now, going back to Google, there are ways, that you can find stocks that are high yielding, but when you go to look at these, they basically base it all on just the yield. So you can go there, and there's other places. NASDAQ has a site, find dividend stocks, and what they're going to do here generally is just show you what the highest yielding stocks are. But we don't know if they're safe. You got to still continue to do your due diligence to make sure that these stocks are safe. So, a lot of these, those are super high dividend yields, but are they safe? In the VectorVest program, we have the ability to go to our watch lists and we have it set up for you where we have watch lists built already for you that lets you know what stocks have not, again, only paid but grown their dividends over a period of time. So we have what we call our drip lists in our watch list portion of our program. The first one is DRIP 10 to 24 years, and what the DRIP stands for is the Dividend Reinvestment Plan. So all of these stocks have a dividend reinvestment plan, and the 10 to 24 or the 25 plus simply means that each company that shows up on these watch lists has paid and grown their dividend every year for this time frame. So naturally, we usually skip right to the 25 plus, right? So these are also known as the dividend aristocrats. And so we'll take a look at some of the stocks that reside here, right? T. Rowe Price, there's AOS, right? The company, it's grown its dividend every year for at least 25 years. Some of these for much, much longer, right? Well-known, well-established companies that continue to have high relative safety numbers. Their earnings growth rate numbers are going to be strong, right? What generally happens with high relative safety stocks is that all of the other numbers that are important to us tend to fall into place. Not always. You can get a lower RV or some other lower numbers with a high RS stock, but generally speaking, the higher the RS, the quality of the stock really comes out in the other numbers as well. And so that's a DRIP watch list that we call. Again, 10 to 24, we have even 5 to 9 years if you want to catch them earlier. So we have the ability to do that. And so I pop AOS up here one more time. And again, we know the price pattern. This is a 10-year look back. And we know that AOS, and instead of earnings, we have the dividend payout now on the subgraph. I know that AOS has grown their dividends every year for over 25 years, but this is just a 10-year look back. And you can see that staircase of that growing dividend. And that's what we want to see in our retirement portfolio. This was probably a special dividend that got paid out there for AOS. So those are the type of stocks, again, that we're looking for. When we're able to fill a dividend portfolio of these good quality stocks, right? And here's an example of a 5-year look of a model portfolio that we call the blue chip dividend payer. And that portfolio is up and this is just as of last week or June the 1st, losing track of time, a couple weeks ago, up over 73%. Now the key here is to understand that that equity curve does not include the dividend payouts. And I calculate these by the penny, out to the third decimal to be exact, the dividend payouts for the positions that were held, which weren't many in this portfolio. And as of May 29th, it came to $23,406.72. So virtually what's happened in this very basic blue chip dividend portfolio, when you take into account capital appreciation as well as dividends, that it's virtually doubled over the last 5 years, which is pretty darn good for a portfolio that's done maybe 15 round-trip trades over that time frame. Okay, and that doesn't even include the ability of compounding these dividends. Okay. So where does that come from? Well, we built in the VectorVest program, what we have here, and this is just one example, and the one that I used, created this search called Blue Chip Dividend Payers, and put some pretty basic parameters on it. All I wanted were stocks from the Dow Industrials, Transports, Utilities, and the S&P 500. The reason is I want mature, stable companies with high cash flow. These are not necessarily your growth companies that are going to, skyrocket like a Netflix or an Amazon or something like that. The stock has to have at least a 3% dividend yield. You can set this up here, and the stock has to show up on either the DRIP 10 to 24 or the 25 plus. And then finally, we have an indicator called dividend safety. It's our one indicator that's not on the 0 to 2 scale. It's on 0 to 99. Anything above 50 is good. And what that allows us is a positive payout ratio and a history of safe dividend payouts. So that's a big portion of the search. So that's how we go out and we find these good quality dividend stocks. And that's what had gone into the portfolio that I just recently showed there. So that's how we go to look at those stocks. Dividend safety, dividend growth rate, earnings growth rate. Okay, is how we look at it. Staying on the concept of generating income in our portfolio is covered calls. And covered calls, oftentimes I will find when I speak with retirees or folks heading into retirement, or just anyone who may not be very familiar with option trading. And so I'll preface this next portion by conveying as strongly as I can. Selling a covered call or buying a protective put, the goal is not to turn you into an options trader. It's to show you, introduce you to, if you're not using it already, to one of the most popular trades, a safe conservative trade, and a great way to continue generating income in your portfolio. Now, we call it, it's an old analogy, and it's an old, well-used analogy because it's a good one. And we call it collecting rent, right? Basically, what we're doing is charging rent to stocks that reside in our portfolio. That's all we're doing. You want to live in my portfolio? Pay me. The very best definition for those who may not be familiar with a covered call came from a gentleman named Lee Lowell. He wrote a book that Dr. D had read, and we all kind of followed suit with that. And Lee Lowell was a pit trader in the old option pits back in Chicago. And he wrote a book, and I won't read through the whole thing here. You can read through that, but I've highlighted what I think is the best, definition for those who may not be familiar. And he says, the reason you need to understand and trade covered calls is that there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Okay, somebody's willing to pay you to do that. So you sell the call option, you get paid, you take on an obligation. And that obligation is you have to provide that stock if that stock is called away. But all that means is you made more money. That's all it means. And so I thought that's a great introduction to covered calls, again, if you're not familiar with it. And I want to take just a second to walk through the chemistry or the biology, whatever science it is, of a covered call, just to make clear what it is and why it can be so important to providing income into your portfolio. So I'm going to walk through a basic example. Let's say you went out and you bought 100 shares of XYZ and you paid $60 per share for that stock. You then went out and simultaneously sold an XYZ call option, 45 days to expiration, and for that call option you were paid $2. Okay? What happened? Well, your net debit now is $58 per share, and I'm not using commissions here, just so you know. So you would add commission. I'm not using commissions for the sake of the illustration here. So I bought the call at 60. Someone paid me $2 a share for the covered call. So now my cost basis for XYZ is $58 per share. So I've lowered my cost basis. What I've also done is built in a $2 stop price, if you will. Now there's a cushion. The stock could actually go down, and I can still have a profitable trade. At expiration, if XYZ closes above $62.50, because that's the strike price I sold it at, remember my cost basis is $58, which means I made $4.50, which is a 7.7% return on investment. Now again, this is just a quick overview. I'm not trying to, delve too deeply into turning into this if you're not familiar with it, but it's just a 30,000-foot view of how it works. Now, if XYZ is below $62.50 at expiration, we're still long those XYZ shares at a cost basis of $58 or 3% lower than the original price, which is good. We built a cushion, or again, as I call it, just kind of a synthetic stop loss on it, right? Stock could actually go down, go to 59, and we'd still be making money. Now, understand that if the stock does go below 58, and excuse my spelling, losses will occur. Okay? Losses will occur if it falls below 58. But again, you've built that cushion, right? And so you're taking in that $2 credit, and it's going straight into your account. So that's kind of the anatomy of the covered call. Okay. So a lot of investors focus solely on capital appreciation, which you definitely should. It's a big part of growing your money. That is the profit side. We just talked about dividends and covered call income coming in. That's the second core principle that we need to focus on to be successful in retirement. And we've talked about those two. Now, when you add selling options to the mix, you've really compounded the amount of income you're able to generate. And so as we just showed that covered call, what I want to do now is show an example of a covered call and just what it can look like when you follow this process of selling covered calls. Now, DHR, disregard the date. The stock doesn't matter. The date, the time frame doesn't matter. It's an illustration on how this works. And let me just preface this by stating that there's a general rule that says you don't want to sell a covered call against a stock that you don't want taken out of your portfolio. In other words, maybe you worked for Danaher for the last 30 years and you got stock incentives in your portfolio and you don't want to start selling it, whether it's Danaher or GE or Sear or whatever it might be. If you don't want the stock called away, then you probably shouldn't sell covered calls against it. But again, if you do sell covered calls against stocks that you own, you're getting paid for someone to take that stock away from you at a higher price. So let's walk through a quick example of what it looks like. Danaher for the year 2015. And again, the time frame doesn't really matter. From January 2nd to December of 2015. Danaher shares were up just about 6.5%. It's a good quality stock, had a relative safety number on the beginning of 2015 of 1.47. So we own the stock, and as it turned out, it was up nicely. Now remember, 2015, if we're going to use the year, was actually a year the S&P 500 was actually down. It was an off year for the S&P 500. Now, during that time frame, DHR also paid a dividend and had the highest dividend safety rating a stock could get in our database. So the dividend safety rating was all the way up at 99. That's the highest dividend safety number you can get. So for the course of the year, you were eligible for 4 dividend payouts, which added, and it wasn't a big dividend, but it would have added for just 100 shares, $54 to your bottom line. The X is the ex-dividend date. The P is the day they actually pay the dividend. So we focus on the X date. If you owned it on that date, you are entitled to the dividend, even if you sold it for whatever reason the next day. As long as you own it on X dividend date, you get paid your dividend. So that's the scenario. You've got 4 dividend payments. So it added $54. Doesn't sound like a lot, but it's 100 shares and only 1 position in your account. Consider this over time for 8, 10, 12, 15 dividend positions in a portfolio. So that's the dividend side. Now, how about if we had sold covered calls throughout the course of the year here as well? Our first covered call, again, not to go into too many of the details, you would have sold it and you would have collected $70. Usually we go out somewhere between 30 and 45 days out to expiration. In March, the stock did not go above that strike of $90 per share, and so we would have sold a second covered call at the 90 strike. We took in another $143. Following the process in June, we could have gone out, taken in another $123 by selling 1 contract, 1 covered call for $1.23 per share or $123. We could have done it again in September for another $210. Now, by that point, our 100 shares of DHR would have been called away at $90 because it did get above the $90 strike price. So it would have been called away. And that's okay, though, because we got to keep that $210 plus all of the other premium. So let's look at it this way. For the year, heading out to the end of 2015, we had $551 in capital appreciation. We took another $54 in dividends and $546 in covered call premiums. That's $551 cap appreciation versus $1,028 when we add all those up together. So yeah, we would have lost the stock. We could buy the stock back if we chose to, if it were called away. Other techniques, or we could just move on to the next quality stock and fill our portfolio. But that's just a quick illustration of the power of dividends and adding income by selling options, covered calls specifically. So I'm going to take a sip of water again, and I think I know the answer. But what would you rather have? Growth only with no additional income? Or would you have the growth and income? Type G and I in there if you'd rather have both and have your portfolio grow this way. Remember, our goal is to keep making money in retirement. Tamura says, gee, I want growth and income. Certainly do. David and Anthony and Bruce and Edward. Yeah, it's just logical, right? It makes sense that if I've got a way that doesn't take too much time, too much effort, I can continue to grow my portfolio by keeping an eye on this. So let's continue on. The final P in our profit, provide, and preserve comes to protective puts. It's a lot of P's. Protective puts is what we're going to talk about next, and this is how we preserve our capital, right? Our goal is to protect our assets, right? This is where we become proactive. This is the management part of the portfolio. We have to insure. The same way you insure your home, your family, your car, you should undoubtedly be out there insuring your retirement nest egg. I'm going to walk through an example of the concept of a put option. So here's Texas Instruments, right up to fairly recently. It's a 1 year look back roughly. Obviously the stock's doing well, another high RS stock. Let's say you really wanted to be defensive on Texas Instruments. You could buy a put, right? You could buy a put option here. If you own the stocks anywhere at those confirmed up calls I talked about. So the price of your put or your insurance policy depends on where you set your strike price. So just setting up kind of an overview here. So the more expensive but better protection is to buy them what we would call at the money. So the higher that strike price, the more protection, but you're going to have to pay for that. Less expensive, but not as much protection is to buy, again, we're looking at a stock trading at 120. Texas Instruments was trading roughly right at 120. So if I want to buy the 120 put, it's going to cost me a little bit extra. Think of it as a higher cost insurance policy. Here, I happen to have a little deductible to my policy. That's the way I want you to look at it. So either one is fine. There's nothing wrong with either one, right? So here's a quick case study on what would have happened here had you done this. So our case study says, all right, I bought Texas Instruments on 11/24 of 2017. That was a confirmed update, and it would have come in any one of our high RS searches. So good quality stock to own. I know that because look what it did and look what it's been doing. But as I said before, not every stock goes straight up all the time. As of January 17th of 2018, we had a gain of 20%, which is roughly, for 100 shares, $2,000. So it is my job, it is incumbent upon me to do my due diligence and be able to protect my profits, right? Because I don't look at it as I own the stock way down here anymore, right? I look at it as this is my cost basis now. Technically, I do own it at this price. But in my mind, it's trading 120. That's my money. That's my stock. How do I protect it? Well, again, because we do our due diligence, we know earnings are coming out. We want to protect those gains. What could I do? Well, I could go out, and in this case, for example, I buy the higher priced insurance. Again, you could buy the cheaper insurance at $115. Either way, in our example, it would have been very beneficial to you. Because even high RS stocks can have earnings and earnings overreaction. It could struggle based on one piece of information or some forecast, even though it's still a good quality stock. And here, what happened was Texas Instruments, after this earnings report, did gap down. So what happened? Your put option or your insurance policy increases in value, and that offsets the losses on the stock. So now that $423 put that you bought, that one contract, is now worth $1,128. Okay, that's called an insurance policy being worth it, right? Well, what do we say about insurance all the time? I always say it's better to have it and not need it than to need it and not have it. And that was evidenced here in this example. So had you not bought insurance, here's what would have happened. Your gains before earnings, again, we determined was $2,000 on Texas Instruments. After earnings, the stock dropped and it cut your earnings in half. Now you only have you still had a profit, but you were only up $1,000. So that is a drawdown. That's a big drawdown. Now, with $1,000 of your profit gone, that's if you didn't buy insurance. Had you bought a put as an insurance policy, your $2,000 gain would have been offset. You had your $1,000 gain still because you bought a good quality stock at the right time. You were proactive and said, I'm going to go out and protect that asset knowing that earnings were coming out. And so you made $700 on the put option, which leaves you with a position of $1,700 after the earnings. So yes, you did have a bit of a drawdown. You protected yourself, but you still own the stock. You can still collect dividends. And if I'm not mistaken, the stock has performed pretty well since then and made its comeback. That's the beauty of the high relative safety stocks. So it's called mitigating drawdown. Instead of sitting and watching, having that profit need to double to get back, you were able to mitigate the loss with an insurance policy. So that's the power of the put option. Okay, so again, you only lost $300 of profits instead of $1,000. Now take that with a full portfolio over time, over 3, 5, or 10 years. Those numbers become pretty impressive and pretty important when we talk about the ability to minimize drawdown and mitigate risk in your portfolio. So by being able to know when to strategically place those insurance policies, you're going to drastically minimize your losses. So once again, you don't have to type this one in, but what would you rather have, protection or no protection? Okay. I know the answer to that one. You don't have to type that one in. So I said at the beginning, I wanted to show you how to get a retirement that gives you peace of mind. And to do that, we were going to focus on profit, provide, and preserve. So that's the focus where we want to do that. So we talked about the first few, the 3 core strategies we want to use: buy good, safe, quality stocks, dividends and covered calls to generate income, and be able to preserve by using the put option. We didn't talk much about the collars, but we focused on the put option. The collar is a trade that does include a put and selling a covered call simultaneously. It's a great trade. So with those in mind, putting aside the other portions of this, on the slide here, and you can type this in, you can write it down on your notes. Just want for your sake to be aware, what are if you were doing this, right, and you wanted to start to manage and build and plan for your retirement, what 3 projects would you need to be focusing on in, say, the next 90 days? Right, of the things we talked about. I asked earlier, where were you struggling in retirement? What was difficult? Now that we've focused on these things, what do you think would be a good way to do that? Now, you can type in, we can talk about some of the answers, but this is more for, yeah, Steve said reduced time required. Right, there are a lot of folks who don't want their retirement years to be spent sitting in front of the computer. And again, these strategies that we talked about don't require you to do that. Now, does it take now and then? You got to check, make sure you stay on top of it. Of course you do. And folks are typing in, yeah, reduced time required, Stephen said. Peter says buy stocks and blue chip dividend payers. So he wants to focus on that. That's great. Remo has maybe the best overall answer here so far is just make a plan. Right? Make a plan. I like this one. Dinakar says covered calls called away. Well, when dividends are paid. I'm sorry. That was a different one. I like that too. Yeah, covered calls called away when dividends are paid. Yeah, that's fine. Yeah, I won't get too far into that, but that's good. We want them called. If we have a covered call, if the stock is called away, all it means is we made more money. It's a profitable trade. It's a good thing. Russell is the one I really liked. He said, review the stocks I own and build a portfolio for growth. I love that one. Review the stocks that I own. So that's a great way to do that. So at the beginning, as we're getting close to the end of the hour, I had said I'd show you where to go for more help. Now we kind of scratched the surface, laid out what we want to do. I want to show you where you can get more help and show you some of the results from that help. Now, I showed this earlier. There's a growth portfolio that focuses solely on high safety stocks. This portfolio uses relative safety. It uses some other unique parameters and a specific search that's up over 538%. I used a 10-year look. People say, well, why 10? Some people use further. Some use only 3 years, 5 years, which, by the way, this also performed very well. I used 10 years because I got tired of people saying, well, how does it work? How did it work through 2008? Well, here's what happened in 2008. If you remember, there was a spike, a dead cat bounce in early 2008. This portfolio performed really well. That's when the crisis hit. And even though there was a drawdown, a pretty big drawdown, the value of this portfolio, this line here is the initial investment of $100,000. Its low was down $233. At the very worst point of the 2008 financial crisis, this particular portfolio went underwater by $233. That was its low. Now again, there was drawdown, but that's why I went back. The 3 and 5 year looks are really great too. In fact, we began one of these in one of our group coaching, and then we started it on the April 17th. The April 17th confirmed up call. And in just 2 months, from April 17th, this is up over 18%, the same search. I talked about covered calls here in our session. This is a portfolio that focuses on one trade per week, what's called a buy right. Okay? Buy the stock, simultaneously sell the call, do one trade a week. This portfolio, this model is over 3.5 years old now. It's got 83% winning trades, just under 20% annualized, and it's currently up over 65% in that time frame, doing one trade a week. We call it the RIP. It's the Retire in Peace portfolio. Okay. So these are the kind of things we could do. So where I want you to consider, if you're looking for more help, if you're looking to take your retirement nest egg to the next level, what we have here is a new course for you. It's a new live stream course called the Ultimate Retirement Solution. And to Dr. D's point earlier on, we call it, again, the way to keep making money while you enjoy life during retirement. That's the key, the Ultimate Retirement Solution. And the answer to not running out of money in retirement is to keep making more money. And so we have a 2-day workshop, and we'll teach you how to manage the 3 main retirement portfolios or strategies that we talked about so that you can get that peace of mind. Okay, we're going to have you building a growth stock, a portfolio of safe stocks that'll focus on capital appreciation, a retirement income portfolio that focuses on both dividends and income by selling covered calls, and then how to, again, strategically place those defensive measures in the portfolio. Here's a quick agenda of the 2 days. Again, it's going to be live streamed from our training center. You can join us here, or you can watch it from the comfort of your home or office. The live stream will be recorded, and it takes place on June 22nd and 23rd. That's next Friday and Saturday, and it will be recorded if you can't sit for the whole thing. And what we're going to talk about is the VectorVest system, how we find, rank, and analyze these high RS stocks. We're going to go out and show you the trading methods, the portfolios, the trading plans that are behind it. The same thing for the dividend portfolio, how we rank and analyze and find the very best dividend payers, and then build that portfolio. Portfolio. That's what's so important. Not only finding them, both dividend and high growth stocks, but also building them, the trading plans that go behind them. That's the important part. We'll show you how to do that when we implement these plans. And then at the end of the day, for a few minutes, we'll segue into day 2, which is going to talk all about the intro to the trades we need to know. Again, protected puts and selling covered calls. We talked about how important that is for generating income and preserving your portfolio. We'll go much deeper into the covered call strategy, how to find the right stocks to do it, portfolio insurance, and then we'll talk about the collar trade, which is simultaneously selling a covered call, using that premium to protect your profit in the stock. So very low cost insurance. Okay. So very valuable, very important steps to man. Day 2 is all about managing, protecting, preserving your portfolio. Finally, we walk through the income portfolio, which is going to be, I think life-changing. It is that portfolio that's up over 65%, 83% winning trades, a steady income of doing one trade a week and generating almost 20% per year. Okay, it's a pretty amazing way to conservatively and easily increase your income. Someone sent me an email the other day who was in one of the retirement courses and said he mentioned to his broker or his money manager about generating 15, 18, 20% a year. And his broker told, this is why it's important for you to come, by the way, this is why I'm telling this story. His broker told him the only way anyone could ever generate more than 10% in their portfolio is to be extremely aggressive. And that sounds like a money manager who is paid not based on the success of his client, but rather the products he sells them. I vehemently argue that you have to be aggressive to make more than 10%. Buying safe, undervalued stocks, rising in price, understanding the proper stocks to sell covered calls on. When you know how to do that, you can make 20% or close to it very safely, very easily in your retirement. Don't fall for those who say, 2-3% a year or just keep up with the S&P is what you need, because that's not going to keep it going for you. And then finally, at the end of day 2, we'll talk about the Ultimate Retirement Solution game plan, and we'll put it all together for you. Okay. Now, for this 2-day course, again, that takes place June 22nd and 23rd, live streamed from our training center here. Order today, and we're also going to give you 4 bonus implementation webinars. So order today, you'll get these bonus sessions. That means after the course is complete, you will continue to get weekly coaching sessions to go over what we learned in the course. I will be hosting those. Right? A lot of times, if you go to a webinar or a seminar, you leave there excited, but then you don't start doing things, or you might forget something. You don't have that recall to go back and put it in practice. Well, these 4 bonus sessions are there to help you overcome that. So if you forgot something or new questions have come up, I will be there to guide you. Okay. Plus, every week we'll do that during live trades. We'll show live trades for our income portfolio and how we manage these current portfolios that are actually open. So we're going to go ahead and do that. To sign up for the course, you can go ahead and go to this link, www.vectorvest.com/URS. That's the Ultimate Retirement Solution. vectorvest.com/URS. Now, for the Retirement Solution course, it's really, I don't know, it's a bargain at this price. I just believe that it is for what we do. The 4 bonus coaching sessions, as well as the ability you'll have access to a dedicated email as well. So any questions will come straight to me in a retirement email where I can get back to you as quickly as I can. Sometimes it gets filled, but I get back as quickly as I can, and I have some help to do that as well. The special price for this Ultimate Retirement Solution course is going to be $395. Okay, the regular price is just $495, which is still a bargain. We're going to give it to you for $395. However, that price is going to increase Friday night at midnight. So if you're interested, you can go to this link here. You can sign up at vectorvest.com/URS. If any of you are doing that now, go ahead and type in here. Let me know you got to the link, that you're interested, or that you got in. Okay. And what you can expect once you do that is an email from us in the middle of next week that's going to give you, oh, look at that, good segue. Someone asked, what's the elite price? The elite pricing is $247.50. What you're going to receive when you sign up is going to be an email with instructions on how to enter into the live stream. And what we're also going to do for this is give you a free 30-day trial for the auto timer, because the auto timer to help set up and see some of the templates we're going to be using is going to be necessary as well. So we're going to give you a free trial to what's called our auto timer add-on module. So the seminar is Friday and Saturday. We'll start at 9 a.m. Eastern time both days. We'll wrap up roughly 4 o'clock Eastern time each day, give or take a few minutes. Again, if you can make one day and not the other, or miss part of a day, this is recorded. Roughly a week to 10 days later, what we do is send it out to you, a link, the entire seminar, and you have access to that along with the slides that you get as well. So you'll have access to all of this. Okay. And Nicholas, yes, you will get the bonus if you're signed up. That's great. Thank you for signing up. Very good. Okay, so that's our setup there. I'll come back to this, but again, it is June 22nd and 23rd, live streamed from our training center right here in Cornelius, so that you can watch it in the comfort of your own home or office, and then get the replay and be able to watch it, pause, rewind, do whatever you want to do with it. Okay? All right, folks. Well, that's the setup. Thank you. I'm going to go ahead, and John has been very kind to help me in the background answering questions that are coming in. I'll try to scroll up or ask John if there are any specific questions here that I can answer for you. In the meantime, if you have questions, you can go ahead and type them in, and we'll go ahead and answer some of them. So one I see here is Sam is asking, what is the elite price include? Well, we have, Sam, what we call, if you're an elite subscriber, it means you've been with us for a certain amount of time or own a certain amount of products. If you're not sure if you're an elite subscriber, go ahead and give our product support floor a call. I'm going to type in 658-7638. I just typed into the chat box to everyone the product support number. If you have any questions about this, our product support floor will be happy to answer any questions. So you can go ahead and do that. And that's fine, Sam. If you're already a subscriber, then go ahead and sign up for the course and you'll be ready to go. Okay. I'm going to scroll back up here and see once again if anyone has questions or comments, or if you were able to get in and sign up, let me know. But let's take a look at some of the questions here. John has flagged a couple. I'm going to start with Tamira's question of what amount can you have to start this type of portfolio? What amount can you have to start the portfolio? And yeah, that's, you know, it's a great question. We get it all the time. The amount that you need to do these things. Now, I laid out 3 strategic plans, right? Growth by buying good quality stocks at rise in price. A dividend portfolio where you're buying stocks and your goal really is that safety and dividend income. And then finally, the ability to sell covered calls in a separate portfolio. It doesn't mean you have to employ all 3 techniques at once or even at all. You can choose to do any 1 or 2 of them and allocate your assets to those strategies. Right? Ideally, we'd love to be able to see the spread of all 3 of them. But, you know, covered calls, it's hard to put a number on it. I usually don't ask what people have to put out there or what they use. But, you know, as far as the growth part of it that you've allocated towards the equity market, it could be $10,000, $15,000, $20,000 just to build a growth portfolio. You know, it could be less to buy, you know, that you're going to start in your IRA, you're going to begin to, or a regular account, you're going to begin to buy good quality stocks. right? For the covered call strategies, it does take a little bit more because you're going to be buying, you're going to be purchasing the stock and selling the covered call against that. There's one I want to answer. I just saw come up there. Claude was asking, what has changed in this year's presentation from last year's retirement course? Claude, the biggest change here from last year, right? We had the worry-free investing course. There are some overlaps here. The concepts are never going to change. High relative safety stocks, buying those companies at the right time, and then moving forward. What's changed? A couple of things. First of all the examples are updated, but what may be most important is the retirement growth portfolio, the search that we use, and the trading plan behind it. This is, anyone who signs up for the course is going to get the full trading plan behind this retirement growth portfolio. So that may be the biggest change. Like I said, everything's updated. Every seminar I do, every class I do, I go back, watch it, and try to figure out a way to make it better. I like to think that some parts of it do each time, but so really this will be the biggest thing there. All right, fantastic, Claude. All right, we'll see you next Friday. Claude is in. Thank you. Let's see if I can continue. John, as I'm looking, if there's any questions that you want to, that I might miss that you think are important. Thank you, by the way, for answering these questions in the background. Jerry was saying he did the 30-day retirement course. Yeah, that's an older one, Jerry. This one is very different from that one. Again, I think improved. It's much more focused on a step-by-step building the foundation on all of these things. So, yeah, that one's changed a lot. Let's see. Remo, his comment and question here is, have been searching and searching for an investment program that does not require constant monitoring. Looking for one where I can review briefly each evening and for a short session on the weekend. This may be the holy grail. Is it a fit? And my short answer to you, Remo, is yes. This is exactly the course you're looking for. Now, as I always say, you can make these things as time-consuming and complicated as you want to, if you choose to. But the beauty of all of this is that we don't want it to be. Right? We want it to be easy. We want it to be straightforward. And of course, we want it to be successful. Sometimes less is more. Watching every tick, watching, every headline or every tweet that comes out, can force you into decisions that you might not otherwise make. So a few minutes a night, a few times a week, a few minutes on the weekend, to look for those times where maybe you need to be strategic and place the protective put or a collar trade or, or adjust something, but it's not something you've got to sit and watch tick by tick throughout the day. Nicholas, great. We look forward to seeing you there. Bruce is asking, what are the 4 bonus webinars? Bruce, what those 4 bonus sessions are live sessions that I'll be hosting, and we'll go through the seminar. We will actually go in and build portfolios on the first day of the webinar. I'll walk through with you how to actually build these portfolios. We will have done that in the seminar already, but I'll walk through it again. We'll track them each session for 4 straight weeks. Each week we will do a income trade, the covered call trade, which we call the retirement income portfolio. So I'll actually walk through a trade and the process each week to do that. And of course, we'll open it up to any and all questions that you have regarding the seminar and the things that we're talking about. So, just those alone they've been great. We've been doing that now for the last few years with the bonus sessions, not just in retirement, but the other courses my colleagues do. And we've really gotten some great feedback. It's a good long 4 hours of live training. And again, if you can't attend those live sessions, they're all recorded and they will be sent to you. A link will be sent out. Rob, the course will take place next Friday and Saturday. Again, it'll be Eastern time. It'll begin at 9 a.m. and go roughly to 4 p.m. Eastern time, and the same on Saturday. And just keep in mind, if you're not able to get the live stream or be in front of the live stream, they will be recorded and sent out to you. You'll get a recording of the full 2-day seminar to be seen. And like I say, it takes about a week, maybe 10 days, we'll call it, we edit it up a little bit, get it ready, and then we send you a link and you can watch the entire seminar once again. So I'll be there, and I will be joined by my my wonderful colleague, Miss Kathy Onan, will also be there helping me out. So that's what we'll have. All right. So let's see. I'm going to keep going through the questions. As long as you guys are here, I'll keep going through them. We talked about what time. Bruce, the bonus sessions, what we do is we give it time in between the end of the 2 weeks, and then we do it the week after you get the video, so that you've taken the 2-day seminar, you've gotten the video back to watch for a little bit, go through, formulate any questions you have, and then the bonus sessions take place shortly after you get the video. And you'll get an email with the exact dates and times when that comes. Okay. Joan says, will the seminar and bonus give specific guidance on how to use the VectorVest data? I've had it for several years before I retired, but never figured out how to use it. Joan, again, just like Remo's question earlier, yes is the answer. We will directly be in the VectorVest program. As I said earlier, instead of you going out and trying to figure out what's a high relative safety stock, we're going to show you how to find it. We're going to show you the searches or scans or strategies built in. We're going to show you how to take those, put them into a portfolio, create a back test so that you're comfortable, right? Confidence is the key, so we back test some of them to show you. I've done all that. I'll show you my results. I'll show you how to do your own results. And more importantly, I'll show you how to create the portfolio. All of it done in the VectorVest program, the portfolio manager, what we call the Genius, backtesting tool, and the Unisearch tool. All of this is going to be very specifically focused on building and managing your retirement portfolio. This is not just an overview of how to use VectorVest. It is a specific step-by-step process on how to use it. Okay, Bruce, I think I see your question come up again. The bonus webinars, we talked about that about a week or so after the recording comes out. They are recorded, and they will be, I want to say they're going to be 4:30 in the afternoon, but I've got to get the dates and times. We're going to determine that and get it out to you well before they take place. We'll give you plenty of notice on that. Remo's asking, does this also address swing or declining markets? And Remo, it does. It doesn't have us trading those markets, but what it does specifically is have us recognizing strategic times in the market when we need to be proactive. And what I mean by proactive is defensive. So if the market is starting to sputter, if an individual stock is starting to move sideways or move against us, we're gonna analyze and recognize times where that protective put, the covered call may come in, or based on the trading plan when it's just simply time to sell the stock. Right? These trading plans all have very specific rules and guidelines that we're going to use, including the retirement income portfolio, where you'll by taking the course will have access to the strategy or the search that we use, to the parameters we use and the trading rules we use. Again, that have generated 83% winning trades and almost 20% a year annualized rate of return in that portfolio. Okay. Joan, if you have a question, you can give a call again to that 888 number, 658-7638 that I typed in. You technically wouldn't be resubscribing to the program. You'd just be signing up for the course is all you'd be doing. And again, we will get the bonus sessions out to you. They will be during the day. The bonus sessions will be live either at 2 or 4:30. I don't know the exact time right now. They also will be recorded. So that evening you will receive that day's recording of the live sessions. Okay. All right. All right, folks, if you have any other questions, I'm happy to help to answer any of these if you're still in here. As long as there's folks in here, I'll stay Tom's saying, I have end of day service. I don't see the retirement tab. Not sure which retirement tab you're speaking of, Tom. And what we're going to do and show in the program, you can do all of the techniques and tactics and strategies we're going to use with the end of day service. So again, if you already are a subscriber, all you'll need to do is go to vectorvest.com/URS. You can sign up right there. Remember, the price does go up on Friday at midnight. But Tom, you would be all set. An end of day is fine to use for what we're going to do. Timothy's asking, do you teach us how to do the option trades in the course? And I do. Yeah, we're going to walk through how to go in and actually place those trades. We're going to have case studies, how to go in, how to determine your expiration date, how to determine your strike price, and we're going to do that. Okay. James is asking a question that was asked earlier. What is the recommended minimum capital? And James, that's always a difficult question to answer. Depending on which technique or strategy, again, you can use all three. You could use one or two of them, as different tactics to grow and protect your portfolio. In the growth portfolio where you're just buying stocks, it doesn't have to be much. It could be anything. I mean, at some point, if you've got cash allocated to the equity market to grow for retirement, it almost doesn't matter how much. It just means you might be buying fewer shares. And then for the covered call side, you do need, remember, you're purchasing the stock, and you do need to purchase at least 100 shares of the stock. So that may require a little bit more, but that's where we're at. Timothy asks, what VectorVest subscriptions do you need on an ongoing basis, and what is the cost? Well, Timothy, you can use, again, the VectorVest 7 program. The end of day version will do it. We have several versions. We have end of day. We have one called intraday, where it's a delayed quotes coming up, but streaming, it looks like real time, but keeping in mind it's a 15-minute delay. And then we have real time, where every tick for stocks, prices, our proprietary numbers are all live in real time. What you need would be just the basic VectorVest subscription, right? The end of day. And that's really all you need. And you can do that either monthly or annually. And again, you can call 888-658-7638. I put that in the chat box. You should have that there. And you can go out and give them a call, and they'll walk you through the details of that. All right. James, would I recommend rolling over your 401k to this? Listen, I won't go that far. I'm not familiar with the details behind that, but listen, you can all of the trades we're going to talk about, selling covered calls, buying protective puts, and obviously buying stocks, are all allowed in an IRA account. So all of these trades I'm talking about can be done in an IRA account. So depending on your 401k, what your investment choices are, maybe you want to take a portion of it and move it into a regular IRA and do it. I want to be clear, that's going to be up to you if you want to do that. Timothy's asking, do you need the options trade program? Timothy, you may be referring to Options Pro software maybe, but whatever you're referring to, the answer is no. Any of the option trades that we do are going to be very basic, and we're only going to do two: sell covered calls and buy protective puts. We'll do 3 trades if you want to include the combination of those two in what's called the collar trade. But you do not need any added option software. Anything you need will be easily found in your brokerage account. Okay. So again, vectorvest.com/URS. You can go ahead and sign up there. And we hope to see you there. And Timothy, yeah, listen, if you've never, that's the point I was trying to convey earlier. If you've never traded options before, that's fine. This for the folks who are still in the room here who maybe don't trade or are not familiar with options, believe me, don't don't shy away from this because you think the second day is going to be an options course. It is not. We are going to, the first session of day 2 is going to talk about a general overview of what options are and why they're important to what we want to do. The rest of that is going to be how we very, very specifically address the trades and the purposes and the strategy behind placing just those 2 trades. So I just want to be clear for the folks who are still here in the room that's going to be our focus. It's not to turn you into an options trader if you're not already. We're not going to bog you down with the jargon and the lexicon of option trading. The first session of day 2 will just give you an introduction. But after that, every one of these is very specific to what we're going to do based on the portfolios that we build on day 1. I tried very, very hard to make sure that each session, each talk, built on the previous one. And the same thing is going to be for day 2. How do we take this and apply it to what we learned here? Right? Because knowing the jargon or the theoreticals is important and it's great. But if you're not comfortable or confident in how to actually apply it, then it becomes kind of useless for you. I think anyway. Okay. All right. There's still folks in the room here. I don't see too many more questions coming in. John, if you're there still, and thanks again for answering it, do you see any I might have missed that I might comment on? Let's see if I scroll back up. When the questions come in fast, sometimes they get lost, and you got to scroll to find them.
I didn't see any, Jim.
Okay. All right, cool. Thanks, John. James says the registration site does not show the live coaching bonus. No, it won't, James. Just know that once you register, our system knows to include you on the email that's going to go out that tells you the exact dates and times of those sessions, and it'll be shortly after. Remember, as I said earlier, what we're going to do is we're going to have the live stream course. I'm going to say roughly 10 days later, we're going to have that course that's recorded and taped sent out to you so that you can continue to watch it. And it's at that time that we will set, very shortly after that, the 4 weekly coaching bonus sessions. So don't worry, it's not on the registration form, but by registering, it automatically enrolls you in those 4 bonus sessions. And even if you can't make the live session, they are recorded, and you will, again, have a dedicated email. Roger that. Thanks again, John. You will have a dedicated email where you can send over anytime questions that come directly to a distinct bin. And again, we do our best to get to those as quickly as possible, but it doesn't get caught up with all the other emails within the program. Okay. Timothy's asking, is there any advantage to attending the course in Cornelius versus online? And Timothy, as much as we'd love to have you here, we do have a number of folks. We can house about just under 20 folks in our training center. I don't think there's a distinct advantage of actually coming here. Either way is going to be great. We'd love for folks to come. We will feed you. We've got nice catered lunch every day. It's one of the best things about doing training sessions in our training center is we've got they're like really dinners that we have for lunch, and they're unbelievably good. So that might be the biggest advantage. You get to meet us in person. You'll be much more happy to meet Kathy than me probably, but that's it. James, I don't think you need to answer. You don't need to. James is asking about the discount code, and we should be okay with that. But just by registering and putting it in there at this time, our system knows that the price again will increase on Friday at midnight. So let's go here. And again, if you're an elite subscriber, you will get the $247.50. Joan, thank you very much. I'm glad it was helpful to you, and I'm hoping to see you in the chat room next Friday and Saturday. All right, folks, it's just about 1:30. I don't see any more comments or questions coming in. If you do have any questions, please call 888-658-7638, and our product support folks will help you out with that. Or just go to vectorvest.com/URS. And again, thank you so much for taking the time, and I do hope to see you next week at the Ultimate Retirement Solutions Seminar. Thank you, folks. Have a safe week, and we'll see you soon.